So let's do a quick example. So let's say, for example, let's just bring it back to my little samosa business that I started up. Let's just say I determined that when I was in my business planning and everything that I needed to raise $1,000 to start the company, and I was able to, and I got $1,000, but I was able to raise 500 out of from taking out a bank loan and $500 from selling some ownership in the company. On a balance sheet, I would represent that $1,000 in the following way. I would have, under the liabilities side, I would have a loan of $500. And the $500 that I had raised from selling part of ownership in the company or selling stock in the company would be represented in the share equity account under common stock. That would be $500. So that $1,000 that I raised in capital, in money that I raised, is represented on the balance sheet in this type of format. In the liabilities, the amount that I borrowed, $500, would be represented under liabilities. The amount of stock that I sold in the company would be represented in the share equity side. Now, at this point, I would have obtained $1,000, and that $1,000, what I would do, and we talked about it, the first thing I would do is I would put it in the bank. Now, on a balance sheet, that would be represented under the asset account, and specifically under the sub-asset or sub-account would be under called cash of $1,000. And so when we talked about the liabilities and the shareholders' equity, the total amounts there should always equal the total assets. And so as you can see, I've raised $500 from borrowing and $500 from selling stock for $1,000, and that $1,000 is represented on the asset side under the cash account because it's sitting in my bank, $1,000. So that's what my company would look like on day one after financing or raising money for the business. So I've got I've got $1,000 sitting in the bank. Now, as we said, I can't, I'm starting a samosa business, so I'm going to need to make some investments. I need to spend some of this money to invest in certain things to get my business, to give me the capability to produce samosas and to sell it. So what am I going to do? We talked about the different activities, and I'm going to clear some stuff out. Let's see if I can do it. I don't think I can do it. No, that's not going to do it. Hold on. Just bear with me here. I think I'm going to have to clear it all out. Let me just clear it all out. So I said I have liabilities, loan, 500. I raised, issued some stock. $500, and now under assets, I had $1,000 in the bank. Now, I need to make some investments. I need to make some allocations. I have to allocate some of this money to the things that I need to get my samosa business up. So if I need to buy a building or lease a building or something, I need to spend, let's say I had to spend $200. Again, I'm just trying to be very simple numbers. We'll get into a real-time balance sheet in a second. I just want to show you the quick relationship. So if I invest in a building for $200, or I need to have some materials or inventory, I need to have some inventory of samosas. Let's say I spent $300. And because I've spent $200, that's $500 I've spent ultimately my cash account, which was originally $1,000, is going to be $500. And as you can see, everything is still in balance. We have loans of 500, stock of 500. That stays the same. That's $1,000. But now that $1,000 that was sitting in cash is now being drawn down and allocated to other capital items that I'm going to need to get my samosa business up and running. So really, that's one of the core features of a balance sheet, and it's what makes the balance sheet so unique, is that the sources of capital are always equal to the total assets. So I'll write that down. As a company essentially makes decision to spend or invest its capital, the cash account and the cash account is essentially going to get bigger and smaller. It's going to expand and contract accordingly. And ultimately, when a company sells the product and service and pays for it, for those expenses, the cash account, again, remember that cash account, is going to adjust accordingly. It's going to get bigger and smaller, and it's going to get bigger as money comes in, and it's going to get smaller as it pays out expenses. While essentially, as these things adjust, the loan, the share equity account will adjust too, depending on how on the profit side to do that. So we're going to get into an example and show you how this all works together. But I just wanted to give you just sort of very, very rough idea of the whole concept of what it looks like, and we'll drill down even further as we move along here.